Hey everyone, and welcome to The Explainer. Today we're diving into a really fascinating corner of corporate finance. We're demystifying the mechanics and the strategies behind preferred stock ownership. If you've ever found yourself wondering how to perfectly balance risk, income, and growth in a portfolio, well, you are absolutely in the right place. Let's just jump right in. I want to start things off by asking a question that might seem kind of crazy at first. Why on earth would you buy a stock that almost never goes up in price? I mean, we're so conditioned to think that the entire point of the stock market is to find that next explosive growth company and watch the share price shoot to the moon, right? But what if I told you there's an entire class of stock designed specifically not to do that? Today, we're completely challenging that basic assumption. So here's our game plan. We'll start with the basics of stock ownership, define what preferred stock actually is, look at its perks and trade-offs, run through a little bit of valuation math, and finally, talk about choosing the right stock. All right, Section 1, Basics of Stock Ownership. Let's establish the baseline. When most people chat about buying stock, they're really talking about common stock. This is a unit of ownership in a public company. But the absolutely key phrase here is residual claim. As a common shareholder, yes, you are the ultimate owner of the firm. But that also means you sit at the very, very back of the line when it comes to claiming the company's value. Now, being the ultimate owner obviously comes with specific rights. You get to vote at the annual meeting, maybe for the board of directors or on big corporate mergers. You have the right to receive dividends if the company actually decides to pay them out. And sometimes you get preemptive rights to maintain your ownership percentage if new shares get issued. But here's the catch with being a residual claimant. You only get assets after literally all other liabilities are paid off. To put that into perspective, take a look at a typical corporate balance sheet. If this firm just shut down tomorrow, they'd take that $3,112 in total assets and use it to pay off the liabilities first, things like accounts payable and long-term debt, which is $843 here. The difference, that $2,269, that's the residual value. That is what's left over to be sliced up among the shareholders. Okay, now that we've set our baseline, let's move to Section 2. What is preferred stock, the hybrid alternative? Preferred stock is essentially this really unique hybrid instrument, sitting right between traditional equity and corporate debt. It basically trades the explosive growth potential and the voting rights of common stock for something else entirely: steady income and security. So you don't get to vote on how the company is run, but in exchange, you get a fixed dividend and a much higher priority in the financial pecking order. And there's a truly fascinating feature often attached to these shares called cumulative dividends. Because dividends aren't a strict legal liability like a bank loan, a company can hit pause on them during tough times. But if your preferred stock is cumulative, any of those unpaid dividends carry forward. The company literally cannot pay a single cent to common shareholders until they have paid back every single missed dividend to the preferred shareholders. Talk about a massive layer of income predictability. Which leads us perfectly into Section 3, Perks of Preferred Shares. Why would an investor choose these? Remember how we talked about being a residual claimant earlier? Well, the crucial thing here is this priority line if a company goes bankrupt. First, creditors and bondholders get paid, but look who is right there in second place: preferred stockholders. You are ahead of the common stockholders. If things go south, this higher claim adds a very real, tangible layer of protection for your capital. Because of that VIP priority and those fixed dividends we just talked about, preferred stock naturally offers way lower price volatility. It doesn't swing wildly with every daily market rumor. That's exactly why you'll frequently see preferred shares issued by huge, stable industries like banks and utility companies. They use it to raise money without giving up voting control, and risk-averse investors absolutely love it for the steady cash flow. Actually, fun fact, legendary investors use this trick too. During the 2008 financial crisis, Warren Buffett famously pumped billions into Goldman Sachs specifically in exchange for preferred stock. He secured a massive guaranteed dividend yield while the rest of the market was literally in panic mode. But, of course, lower risk always comes with a catch, right? Let's get into Section 4, Trade-offs and Limitations. Let's compare the trade-offs side by side to really cement this. Common stock gives you a vote, variable dividends, and high growth potential. Preferred stock skips the voting rights but gives you fixed dividends and lower volatility. Easy enough, but take a close look at that last row, the callable feature. We really need to unpack that. See, a lot of preferred stocks come with what's called a callable feature. This means the company that issued the stock has the right to basically force you to sell it back to them at a predetermined price after a certain date. So why is that a downside? Well, think about it. If interest rates drop and market conditions get great, the company is almost definitely going to call the stock back so they can issue new shares at a lower dividend rate. Right when your investment becomes highly valuable, boom, your long-term gains get capped. So how do we actually figure out what these shares are worth? Let's transition to Section 5, Valuing Preferred Shares, Step-by-Step Math. Because preferred stock is so incredibly predictable, the math is honestly super straightforward. For a simple perpetual preferred stock that isn't callable, the stock price is approximately the annual dividend divided by your discount rate, which is just your expected required rate of return. So let's say a preferred stock pays a fixed $5 annual dividend, and you require an 8% return on your investments. You just divide 5 by 0.08, and there you go, a valuation of $62.50. It's clean, it's simple, and it's super practical. Now, while preferred dividends are usually fixed, sometimes we want to compare them against common stock, which means we need to value a stream of future cash flows that actually grows over time. Finding the present value of a growing annuity, like a structured lottery payout or a growing dividend, requires a slightly different formula. Let's plug some real numbers into this so it isn't just abstract math. Imagine a cash flow, let's say a lottery win, that pays $200,000 at the end of the year, and that payment grows by 5% every single year for 20 years. If we discount that future money back to today's value at a rate of 11%, we literally just plug those exact figures right into our equation: the cash flow, the growth rate, the discount rate, and the time period. And here is our result. That future stream of growing payments is worth exactly $2,236,337.06 today. Knowing this math is like a superpower. Whether you're pricing a simple fixed preferred stock or a complex growing cash flow, it completely empowers you to know exactly what future income is worth right now, so you never overpay. Finally, let's bring the whole shebang together in Section 6, Choosing the Right Stock, Your Portfolio Strategy. Ultimately, it all comes down to aligning the asset with your personal financial goals. Like we've seen, preferred stock is absolutely your best bet if your main goal is steady, sleep-at-night income and avoiding crazy market volatility. Common stock is your go-to if you're laser-focused on long-term wealth accumulation through growth and you want some influence over corporate decisions. The reality is, most savvy investors don't just pick one or the other, they use a really deliberate mix of both to perfectly balance their portfolios. I want to leave you with this final thought. Take a hard look at your own strategy and ask yourself, in your portfolio, do you value a steady paycheck or do you want a seat at the table? Understanding exactly how preferred stock works gives you the power to consciously make that choice. Thank you so much for joining me on this explainer. Keep learning, keep building that strategy, and I'll see you next time.